Hey, hello, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to a quick market wrap up for the trading day tomorrow, and this is for Wednesday, tomorrow, October 25th, 2023. Just very quickly, we'll wind it up. So, the retailers actually panicked yesterday. That's very much evident because the Fyers and the DIs did not sell. So, it was pure panic driven downfall that happened yesterday. That's the truth from the retailer side. Now, why did that happen? We all know it's global cues are not that great. There is an ongoing war that is there. US markets are at resistance and then red since many days, many weeks actually. Currency is at all-time low level, rupee. Crude oil is spiking up, and we know that the gold is where the money is moving, right? When there is a crisis, people shift the money to safer havens like gold. And that's what is the spike that you see. And Fyers has been selling for 14 or 15 consecutive weeks now, non-stop selling by the foreign institutions, right? So the inflation, interest rate hikes, and all these uncertainties also prevail along with the ongoing Israel war crisis. So that's the reason for the panic, obviously. So technically, if you see, we are having a breach on the technical charts in the short term. This is exactly what it is. It's a parallel channel. There's a breach that has happened. Still at a support zone. There is a gap at 201. Banknifty even more weaker. We have 3 months of consolidation and a breach that happened, and we are still somewhere at the support zone. This is natural retracement level, so it has breached the 38%, and the next support could be 42,500 nearby, so 50% retracement, and after that 41,900, 42,000 nearby zones. And a breach of below that would be very dangerous. Anything below 42,000 is not that great, right? And especially Nifty, 38% retracement is still not. It's only 23% of retracement has happened. So there are supports at right below at 19,200. 80 points down, and then 19,000 also could be good support, and then we will have the breach there happens, and breach of Fibonacci 38 also, and then anything below the 18,200 we need to really worry that the market is completely turning around. Under then it's mere correction. Now every dip that happens right now is an opportunity for the investors to buy in small, not in large quantities. When HDFC reach 1,500, buy 100. When it reach 1,500 below, buy some more at say 1940, 450, 400, buy another 50. So likewise, you can gradually add in quality stocks alone, not in junk stocks which are quite cheap. Quality fundamentally good stocks. This is the right time that we get to invest in SIP mode. But the traders right now has to be extremely cautious because the VIX is low now, very low, but it can spike up any time and create panic. So cut short your position size is all that can be done by the traders. Downsizing the positions. If VIX is spiking, accordingly downsize. And always have hedge positions. You don't know what the situation will turn out to be overnight, right? And so always have hedge strategies, especially if you're trading on options. Now, having said that, there is a VIX. There are a few things that we have to make a note. The VIX is at historic yesterday. It went as low as the historically low level of 10, which is 2030. Decades below earlier VIX level is that we have seen. That's very unusual. When there is panic in the market, the VIX is not rising or spiking as expected. Is very unusual, and probably that could be because the option writers on the are not seeing much downside, right? So they're not. So that is why the VIX remains there. So who are the major option players? It's a big sharks who put in more money in there, more than the retailers. It may be big sharks. So big players are not seeing the downside yet. This could be the only reason that India is not falling, and despite the fact that retailers are all on panic and the market is falling. And also that is one thing in the positive side. And another thing is, and on the negative side, VIX can spike up since it's a very low as big spikes. because of the mean reverting nature of India VIX. That could be a threat. The other thing is we have corrected less than 5% till from the top. 2022 means 2222 is the high. From there we have not yet corrected more than 5%. And remember that we are having a rally of 21% or something. So 5% is not a big deal yet. So that's something to keep in mind. Also, one more thing: when everyone is bearish, there is less likely that the market would go continuously bearish. The market is surprised and then can revert back. So keep that in mind. We cannot predict the market. All we can do is manage our risk, study the probabilities based on the charts, and then play accordingly. Manage your risk is all in our hands. Just to wrap up, the levels we already seen, just coming back to that, right? So making note of these levels, so that where we have gap supports is 9200, be cautious when you're taking short positions there, and 19,011, be cautious when you're taking short positions there. Right, so that's what, as long as it holds this 19,200 should be fine if it's able to manage that. If it does not, then 19,000, look at that drop likewise. Similarly, Banknifty, it is even more breach. So look at the Fibonacci level of 61, and any falls below that will be not that great. The Fibonacci level from the previous swing low would give you exactly where the risk probabilities are higher for supports and where the probabilities are higher for resistance on the up move. Likewise, that's how we will trade. That was a quick wrap up, and then hope it helps. Happy trading, happy learning, and happy investing. Bye bye.